We are set up now. There we are. Okay. Hopefully you all see my little graph there. That sort of is a little illustration of hopefully how we're going to get through the, what we're going to represent today on our topic. Okay, today we are going to talk about the simplest high probability trade that you may ever see. And you know, there's an awful lot of strategies out there in the world of trading, options specifically. Some of them can get rather complex. You can do adjustment on top of adjustment, technicals, fundamentals, you know, sentiment indicator, you name it. You can tweak it and adjust it until you have a, you know, 26-legged, you know, 3-sided monster anyway. And then none of that is necessarily bad. But sometimes simple is good too. And in my mind, simpler the better, as long as we don't sacrifice, you know, performance. Anyway, this strategy is a strategy that I've used before. It's similar to what I do for clients, but not exactly the same. And I'll explain it as we go through it. But it is a pretty straightforward way to try to get a fairly high probability trade going. Okay, but we are going to be dealing a little bit with options, which I hope you would expect as being us as an options educational firm. So anyway, without further ado, let me move forward here. Before we get started, I need to let everyone know that I am a principal in PLE Capital Management. We are a registered investment advisor. This no way is an offer of solicitation or anything. Investments involve risk, and none of these things are guaranteed in any way. This is purely for educational. Discover Options is an educational firm. Everything I show here is purely hypothetical and for educational purposes only. Okay. All right. Welcome. Again, what we're going to do today is we're going to try to keep things as simple as we can in the world of options. The cool thing about this approach that I'm going to talk about today is we don't really need to deal with any of the Greeks. Okay, and I know in the mentoring program for the folks that either are in the mentoring or have taken it in the past or may even consider it, the Greeks are always the one kind of area that just people aren't real happy about. It's probably the toughest single area of options. But guess what? We don't have to deal with Greeks when we deal with this particular strategy. You really don't have to deal with any graphs either. For those of you that are familiar with the software and do a lot of option modeling, you may be familiar with some of the analyzed graphs that we use, which are excellent as far as taking a look at the expected performance of a strategy. But we don't have to deal with that. So we can put away the graphs and the lines. We don't have to deal with some strange, funky sounding terms. But there are some basics that we need to know. Okay, we are going to be using options today, and we do need to understand some of the basic terms. Okay, and for those of you that are familiar with options, I'm sure these are all very familiar. These are probably the first things just about that we learn when we talk about options is the basic vocabulary and what some of these terms mean. So we are going to deal a little bit with that. I am going to go through some of these terms, but very briefly. I'm not going to spend a whole bunch of time on this. I'm going to kind of assume that most folks have some familiarity with what these mean, but I am going to kind of touch briefly on them. Okay. The end game here, okay, the thing we're trying to get to is we want to get a strategy that we can implement, okay? We don't have to worry about the strategy itself, so we can put it on and we can kind of not worry too much about it. And we may have one or two optional adjustments for the month. Okay, we may have none. Okay, but the adjustments that we're going to make and that I'll show here are really optional. Okay, so you don't have to do them. some people will do them, and there's oftentimes if the markets go a little crazy, you may want to do them, but you don't have to, okay? This is a strategy that you can put on and sort of forget about it until the end of the month or until expiration, okay? The trade itself, okay, will last a month or more, okay? Some of these things will go on for a really long time. You can kind of stop it when you want, but typically they're going to last 1 month to, 3 or 4 months, okay? It's a pretty high win rate. We want the high win rate. We're always trying to achieve sort of a high expected return, and on one side of the coin is a high win rate, okay? And in this particular strategy, we do get a pretty high win rate. All right, so let's get started here a little bit, and what I'm going to do here is go through a very brief option primer. Okay, we're going to just touch a little bit on some of these terms. And before I get going here, let me just say what I always say in these webinars. If you have a question, if anybody has any question about what I'm saying, some of the material, please just enter your question or your comment in the chat box there. I'll see it here, and I generally like to answer these as I kind of go through. I'll may finish off the page or the comment, but I typically like to get onto these as they come in rather than hold off to the end. But we'll certainly have time at the end too. So, okay, call. All right, for those of you as a basic review, a call. All right, a call gives the owner the right to buy the underlying at a predetermined price, which happens to be called the strike price, over a predetermined time. Okay, options are a finite instrument in terms of time. Okay, that predetermined time or the end of the life of the option is called expiration. It's called expiration. The seller of an option has the obligation, okay, in this case of a call, the seller of the call has an obligation to sell whatever the underlying is when assigned. Okay, as we set up here, the buyer of an option, the call option in this case, has the right, okay, the seller has an obligation, okay, and in compensation for that obligation, the seller is given money to sell the option, so they get paid, okay, they get paid by the buyer, okay. A put gives the owner the right to sell an underlying at a predetermined price. Again, we call that the strike price, over a predetermined time, which is expiration. Okay, that date that the option expires, it runs out, is called expiration. Okay. And in the case of the put, the seller again has the obligation, but this time he has the obligation to buy. Okay. So the put holder has the right to exercise, to sell an underlying at a predetermined price. The seller has the obligation to buy at that price. Okay, so buyers have rights, sellers have obligations and options. Okay, pretty basic stuff. The second part of it, okay, a couple more terms here. Intrinsic value. Okay, and you're going to see this in a minute here when we talk a little bit about how we're going to place some of these trades. The intrinsic value, that's the portion of the option price that is in the money. Okay, is in the money. That's intrinsic value. The extrinsic value is the portion of the option price above and beyond the intrinsic value. Okay, so if an option is trading at $5 and it's $3 in the money, the $3 is intrinsic value, the $2 is the extrinsic value. 2 plus 3 is the total price of the option. Okay, note on extrinsic value, this is where we make our money. Option traders are only concerned with extrinsic value. When we're talking about pricing and options, when we're talking about taking value or collecting money on option trades, it's the extrinsic value that we always look at. Okay, the intrinsic value as far as option trading is concerned really has very little to do with it. Okay, that's purely the part of the option that's in the money. It moves 1-for-1 with the stock. Okay, so we're always going to be dealing, and I'm not just talking about these strategies, this strategy I'm going to go over today. I'm going to talk about all the stuff that you're doing in the world of options. It's really based so much on extrinsic value. Okay, and that we talk about implied volatility and all that sort of stuff. It's all based on extrinsic value. Okay. A couple other terms here that we're gonna need to know today, just in terms of the conversation, is in the money. Okay, an in the money option for a call is when the strike is below the market price. The strike price of that option is below the market price. It's an in the money call. So IBM's trading 100 and I have a 90 call, that's in the money. Okay, the right to buy IBM at 90 is a good thing. It's in the money. It's something that would be exercised because it's below the market. Okay. For puts, an in the money put is when the strike price is above market price. Okay, the put is the right to sell an option. If I can sell that option above market, that means it has value, or it's valuable in terms of exercisability. So same example, IBM 100, the 110 put is in the money because I have the right to sell IBM above the market. Okay, it's in the money. Out of the money, just the opposite. The call strikes are above the market. So in the IBM example, where it's trading 100, if I have the 105 call, it's out of the money because I'm not going to exercise my right to buy IBM on 105 when I can go in the market and buy it at 100. Okay, it's out of the money. It's, you know, it's like a horse out of the money. The put, the opposite. It's the strike that's below the market. So if I have the 95 put, in the case of IBM that's trading 100, it's out of the money. Okay, I don't care about selling IBM at 95 when IBM's trading 100. I just go to the market. So I would not exercise that put. It's out of the money. Finally, at the money, a call and the put are near the market price. So you can imagine this at the money, just the term itself, at the money, means it's right around market price. Okay, sometimes it's very close. Other times it may not be right at that price point, but it's the closest strike wherever the market is. Okay, so the both call and put is nearest to wherever that market price. We call that at the money. Okay, those are the terms that we're going to need to know. I'm going to use those today a little bit in our example here. And that's pretty much what we need to know as far as options are concerned. We really don't need to know any of the rest of the theory very much. It certainly wouldn't hurt, but it's not necessary. All right? Okay, here we go. Here's the first part of the trade. Okay? And I'm going to use stock as my example. Okay, we deal typically with stock, but you can do this with anything that is optionable and you're interested and you're willing, I should say, to potentially take ownership of an underlying. Okay, whether it's an ETF or a future or whatever it is that has a deliverable. You could even do it on the indexes, but the indexes for the most part settle into cash. So anyway, the first part of the trade, or step one, is to find a stock or an underlying that you would be willing to own. Okay, so look for something that you're willing to own, because there's going to be a possibility, okay, that you may end up owning it, especially if you do sort of this unadjusted approach where you don't worry too much about what you're doing. There's a chance that you're going to take ownership at expiration. Okay, there's a couple ways to do this, and again, I'll leave most of this up to every individual. They have their own maybe way of approaching it. One way is to find a dividend-paying stock. Okay, you may want to go out there and look for something that's sort of conservative, stable. one cool thing about dividend stocks is that if you do happen to take ownership of a dividend stock, while you're taking on the next part of the trade, you're able to collect dividend potentially. Okay, chances are you won't be in it that long, but you never know. So that's one thing to look at. One thing to remember about dividend-paying stocks: generally they have lower option prices. Okay, their perception for the dividend-paying stock is very safe, stable, less volatility. When you have less risk or perceived risk in the market, that lowers option pricing. Okay, and when I say option prices, what I refer to is not the absolute price necessarily of an option. I'm referring to the implied volatility. Okay, and I'm not going to use that word too much, but the extrinsic value portion of the option is typically lower. Okay, that additional premium in the option price that's really based on risk factors. Okay. The other thing you can do is go into OpScan. And for those of you that have the software, OpScan is a slick feature. It goes in there. It's got some preloaded scanning in there that can look for option candidates based on a variety of things. Option prices being one of them, expensive options being one. There's a whole bunch in there. You can look for them. You can also customize it yourself. So those are two things, and you may have others that you want or have ideas on, but that's the first thing you want to do is find that stock. Okay, the second thing is determine the below market price you would want to pay. Okay, so if a stock's trading at 80, generally you go below the market. At least that's how I approach it. You want this to be conservative. You don't want this to be an aggressive approach. Okay, so what I do is I go below the market. I look at strike prices of puts that are below market, okay? And then moving into point number 3, I evaluate the price of the put and calculate the yield and net purchase price. So for example, if I've got a stock that's 80 and I'm thinking I'm going to be happy buying this at 70, I'll look at that 70 put. If I can sell that 70 put for 50 cents, I'll do it. I mean, I may do it. That's what I'm looking at. I'll then calculate what my yield will be, how much time has left in the option. I can calculate whatever a yield is, how long the annualized yield, if I want to look at that. And if I happen to get assigned on my put what my net purchase price will be. So for example, if I'm selling that 70 put where a stock is trading 80, my net purchase price is going to be 70, that strike price, less whatever credit I take in, so say 50 cents, so I'd be paying $69.50. If I'm comfortable owning that stock at $69.50, I'm going to go ahead and sell that put. And if I'm comfortable with the yield, okay. Point number 4, I sell the put. And then step number 5, I wait. I wait. That's it. That's the first part of it. And for those of you that have seen my webinar on Ricochet strategy, it's exactly the same. Okay? There's really no difference here. There's a little difference as we get on to the rest of this trade. But that's it. Okay? It's a pretty conservative. The further out of the money you go in those puts, okay, the more conservative it generally is. Okay? All right. Now, there's 2 outcomes here. There's going to be 2 outcomes. Outcome number 1, or one possibility, is that the stock settles at expiration at above the strike price of whatever the put is. Okay, so if I sell that 70 put in this example and stock settles at 75, well, that put's going to go out worthless, right? Because the owner will not exercise his right to sell that stock at 75 or 70 when the stock is trading 75. So the put goes out worthless. Okay, I keep the dollar that whatever I sold it for, I keep that money and I collect that yield if you want to use that calculation. Okay, I realize the yield. At this point, I repeat step 4 of the first part of the trade, which is essentially resell another put. Okay? So if it goes out worthless, I collected the money, now I go and do it again. Okay? So we just keep doing that. Sometimes that can go on for months and months and months. Okay? And let me get, there's a question in here, let me just get to that here in 1 second. The second outcome, though, is that the stock settles below the strike price. The stock settles below the strike price. In that case, we are going to take delivery of the stock. Okay? So in the case of the $80 stock or whatever it was, if I sold the 70 put, okay, and the stocks got down to 65, well, my put then would be exercised. I'd be assigned. I'd be forced to buy it at 70. My net purchase price is 70. Take away my 50 cents. So I'm buying it $69.50. So now I own this stock at $69.50. I've established a long stock position in a stock that I'm okay to own. Okay. A question here from Mike. What about margin on the naked put? Good question. Margin on naked puts are part of the yield calculation. You will have to put up margin. Okay. It's generally the brokers kind of have their own little formula on it. It's a function of how far out of the money it is. But you do have to have cash in your account, typically. Enough cash to cover whatever the purchase price would be of the stock. Okay, it doesn't necessarily mean, for example, if you're selling a put that's way out of the money and the stock is trading 80 bucks and you sold a one lot and it would cost you $8,000 to buy 100 shares, you don't necessarily have to put up 100 or 8,000 for margin, but you do typically have to have that money sitting in the account. They'll charge a percentage of that that $8,000 as margin. And I'm no margin expert. A lot of these brokers do a little differently. They have a little. There's a minimum establishment by the regulators, but I think the brokers have some leeway in how they do that. And then there's different kinds of margin. There's Reg T, there's portfolio margining, which you get a little more favorable margining. So depending on your experience in your account and your relationship with your broker, there's all kinds of ranges in margin on that. But good question. That's a huge part of it. All right. Now the second part of the trade is the sell and the call. And this is where it gets a little bit different than what I do in the past. Let's assume now that we've sold puts. It doesn't matter if it's 1 month or 5 months or whatever, but at some point we are going to take ownership of stock. All right, now we own the stock now. Okay, we're in this trade. Now what we do is we sell the call with the greatest extrinsic value. Okay, we sell the call with the greatest extrinsic value. This is a little bit different than what I do for clients and what I've talked about in the past. We've typically done a traditional covered call strategy where we've gone a little bit out of the money because we want to have some upside participation, things like that. In this particular example, we want to sell it with the greatest extrinsic value because that is basically a way that we're going to lower our cost basis by the greatest amount. Okay. The greatest extrinsic value is always going to be at the money, okay, or the closest strike at the money. We prefer to do these things in the front month because of the way that the options tend to decay or erode over time. Remember, this extrinsic value is going to go to zero. By definition, the extrinsic value is going to go to zero, by the end of the month. Okay, so we're going to collect all that money one way or the other. So I like to do these things in the front month. Most of the time you can, especially when you're dealing with at-the-money options. You do get a pretty, you get paid fairly well to put, you know, that at-the-money call on. Sometimes you might go out the next month. It depends on where you are in the cycle and the stock itself, actually. If you get a stock that's just really cheap as far as option pricing, sometimes you go out 2 months, but 90% of the time you can stick with that front month when you're dealing with an at-the-money option, okay? So you sell that at-the-money option, okay? The closest option, the closest call you have at the money. Okay, step number 2, we determine how much dollars that we collect, and now we add that to our new cost basis. So if we sell it for 50 cents, okay, we basically determine that that money is ours to keep, and we can use that to now lower our cost basis again. All right. Step number 3, we obviously sold the call, and then we wait. We simply wait at this point. There's really nothing here to do. Okay. We've established now a covered call trade. The only difference is traditionally from what we do with this ricochet strategy is we're aggressively selling the call that has the greatest amount of extrinsic value. Again, there's nothing here that you have to do. All the calculations that you need to do are based on arithmetic. Whether you're calculating a yield, if you're dealing it from the perspective of yield, when you're selling the put, for example, or in this case, when you're trying to figure out what your new cost basis is, all you have to do is do the math. It's not necessary for you to know necessarily what the implied volatilities are, or betas, or vegas, or any of that stuff. Okay? So we've got a call or a stock, and now we sell a call, okay, an at-the-money call, and we simply wait. We simply wait at this point. Okay? Again, there's 2 outcomes, okay, and you guys are probably going to guess what they are. The first one is that the stock would settle below the strike price of the call, below the strike price of the call, okay? In that particular instance, the call will expire worthless, in which case we would resell another call, okay? Again, each time we sell that call, we lower our cost basis. Always look at the at-the-money option, okay? At any point in time, we either put a call. Let me just answer. We got a question here. At any point of time, we either have the put or call sell position on, not both. That is correct. Okay, somebody's asking if we either that we have a call out there that we're offering or a put, but not both. That is correct. Okay, in this strategy, we're not doing what we do in the ricochet strategy, for those of you who've seen that, where we're trying to accumulate stock positions. This one, we're either short the put until we collect the stock, until we take delivery of the stock, and then we are short the call. Okay? And yes, this is being recorded. And it'll be available. Generally, the guys in the office, Jim or Jeremy, they usually get this thing posted like an hour or 2, so it'll be out there real quick. Okay, so anyway, if in the first example we sell the call and the stock closes below that strike, the call goes out worthless. Okay, it expires worthless. We keep all that premium that we collect, all the money that we sold it for, we keep it. And now what we do is we simply sell another call. At the money again, the right at the money one, the greatest extrinsic value, we sell it again. By doing that, we're going to lower our cost basis again. Okay? The second potential outcome here is that the stock settles above the strike price of the call. All right? In that particular case, we sell, it should say sell stock at the strike price, not the call, okay? In that particular instance, we would have the obligation, because we're sellers, we have the obligation to sell the stock at that strike price, all right? So then what we would do is we would now calculate our net sale price, which is that strike price, All right. Now I have here, you add your dollars for your call sale, so you get a net sale price. But if you take those dollars that you collected and use them to calculate a new cost basis for your stock, you're not going to want to double count that. So one way or the other, you're going to use that dollar to calculate, you know, you're going to get credit for that money. All right. And number 3 here, we have no more position. All right, we're done. We've taken delivery of a stock by selling puts, and now we've sold the stock by selling calls. All right, so we're out. We have no position. We can calculate whatever our P&L is, and now we start over. Okay, we sell a put again, or whatever, however you want to do it. But we're essentially back in cash, and we want to start the process again, possibly. Okay. Let me speak just real quick about adjustments here. The way that I have this thing laid out, you don't have to do any adjustments at all. Once you sell a put, you can go home and forget about it and look at actually, frankly, you can come back at expiration if you want. However, the markets can move violently, and you know, you may want to make an adjustment. Okay, and we've got a couple examples here of adjustments. If the price of the put or call fall below 10 cents, you can buy back and sell another one. Okay, for example, if we sell a put, the market starts going way up, and we sold the put at, you know, 60 cents or 70 cents or whatever, and the market starts rallying, those puts are going to go down towards zero quickly, or whatever. They're going to head towards zero at some rate. You could let the thing go out worthless at expiration and just keep all that premium and start again, which is what the strategy really dictates. Or if you want, you can go ahead and when that put gets down, or the call, in the opposite when the market sells off. But when that option price gets below 10 cents, you could go ahead and buy it back and then resell again. Okay, so if a put gets down and starts trading at a nickel, you want to go and try to buy that thing back and then resell another put before expiration, you could certainly do that. That could enhance your yield and kind of accelerate the process a little bit. When doing adjustments, you can look in the same month or the next month out. Depends on where you are in the cycle of how much time we have until expiration and what the relative pricing is of the options. And again, this approach can add yield or lower cost basis. Okay, but it is not required. It is definitely not required. You can just, like I said, you can put these on and forget them. You can let the options expire worthless and start again the next expiration cycle. Okay. This approach is really designed to be a very simple, low maintenance, low theoretical approach to option trading. All right. There are risks. Okay, there are risks. Believe it or not, in the world of options trading, no matter how well you simplify it, you try to take away some of the theory, there is risks in options trading. And as you can imagine, it has everything to do with stock price behavior. There is stock price risk, okay? If you sell a put and the stock completely falls apart before expiration, you could end up owning that stock at a price higher or significantly higher than the market price. Okay, that's part of the game. That's why one of the things we can do to mitigate that, of course, is to go further out of the money or below the market price when we look for puts to sell. Okay, but you know, things happen, and you have to be aware of that. The adjustment risk, what I call whipsaw effect. For example, if we sell a put and the market starts to rally, and we decide that we're going to, you know, buy that put back, and we're going to sell something because the market's now higher. We're going to sell a put higher up in strike price, then suddenly the market tops out and sells off strongly. So you end up buying these stocks at a higher strike price than you initially had when you initially sold your first put. And the same thing can happen with a call. The market can sell off. We could see our calls get cheap very quickly. We turn around, we buy our call, we sell a call lower in strike, and then the market bottoms up and screams up, and our calls go in the money very quickly at a net sale price that was a little bit lower than initially what we had on our first strike. So you have to be aware that there is whipsaw potential in these adjustments. It doesn't always happen, obviously, but the potential is always out there. I got a question about weeklies in some stocks. You know, weeklies, this strategy, you can use this for weeklies, I suppose. It's a pretty generic strategy. Time is not necessarily defined in here, although I always pick the first month when we're dealing with monthlies. The weeklies are not going to have, theoretically, a whole lot of difference other than that you're going to have the velocity of changes in these prices going to be much faster. Okay? So when you think in terms of option behavior, as you start to take time away, generally the velocity of risk in options becomes greater. Okay, so conversely, the return is a little bit greater too, especially when you're starting to annualize things out. But things just happen a lot quicker in weeklies than they do in monthlies. And conversely, things happen a little quicker in monthlies than they do if you go out 3 months. So keep that in mind. But you can certainly do this this approach in weeklies. The only other issue I would say, well, no, that's not even the case because we're dealing with at-the-money options in calls. Puts, you might have a little challenge in trying to find something out of the money to sell with weeklies, maybe. But anyway, each stock would have to look at it individually with those weeklies. Okay, here's a quick example, and then what I'll do is I'll bop over to the software real quick, and we'll just kind of look for one, maybe Apple or something. We'll just kind of sift one out here real quick, and then we'll wrap it up. This is a hypothetical example. I put out Microsoft. This is one that we do this on a lot. But let's just say that we decided to sell one October 30 put at $1. Okay, and don't take these prices to heart. I pulled these out partly for illustrative purposes, and I think these were over like a week or so ago, and I sort of average pricing here. So I don't even know what the stock's doing today. Anyway, so one Oct 30 put at $1. All right. So our net purchase price, okay, if we were to buy this, if we got a sign in these puts, would be $29. Right. It's a 30 put. We collected $1. So if we get a sign, we're paying 30, but we keep our $1. So 29 is our basis. Okay. So say we fast forward for a month, stock settles at 33. Our put expires worthless. We keep that $1. The next month comes around, we sell November 32 puts at 90 cents. Okay, well, again, we're a little bit out of the money. We're below the market. Our net purchase price now, we're starting to compound these credits that we're receiving, is now $30.10. Okay, it's $30.10 because it's 32 was a strike price. We collected $1 before, plus 90 cents, so we collect $1.90 total. That brings us to $30.10. Okay, the stock settles at $31 this month, so we own the stock. We own the stock at $30.10. Now we're going to sell calls. Okay, we got to sell one. In this case, we're going to sell an at-the-money call or one December 31 call for $1. We collect that $1. We now lower our cost basis again, $1 from $30.10 down to $29.10. And I won't go through a whole bunch of stuff. I just pretended that the stock settled above it so we could move through the example. The stock settles at 33, so we sell our stock okay, and we close our position, okay. Wait, I just realized I did something here. We sold a 31 call, right? Yeah, we sold a 31 call. The stock settled at 33. We ended up selling this at 31. Not, I think I said net sell price of 33. It's supposed to be net sell price of 31. Remember, if we're locked into that strike price, so if that stock goes to 100, we're still selling at 31. Okay, so we got a net buy price of 29.10. Okay, so we paid we sold it at 39. So that gives us a difference of 1.9. We made a $1.90 on it, divided by 31, 29.10. I'm just doing the math here. So our yield's about 6.5%, not 13%. It's about half of that. Okay. We scalped out about $1.90. We made about 6.5%. If you sell at 33, you make 13%. Okay, and sometimes these kind of numbers do come up, these 10 to 13, 14% rate returns. A lot of it depends on how many times you sell your puts and how many times you sell your calls. It determines how the yield works out. But it's all just straight arithmetic, okay? If you pay $29.10 and you sell 31, you can calculate your rate of return as $1.90, and on a cost basis of $29.10, is 6.5 or whatever % over 3 months. You can do the annualized if that's what you do. I don't usually do that, but there it is. A couple of comments here, and then we'll go over to the software real quick. Why do you want a lower stock basis? The reason I do is because every time we sell an option, we collect those dollars, okay? And the way I do is I take all that credit, whether it be from the puts that expire or the calls that expire or whatever that I sell, and I throw that into sort of the constant lowering of stock basis. Okay, because once I own the stock, ultimately I'm going to know I'm going to turn around and sell this at some point. Okay, unless this thing just goes down to zero. At some point my call is going to get exercised. And what I'm trying to determine is, okay, my cost basis keeps going down. At some point I'm going to sell it. What's my rate of return going to be? You could do it a couple of different ways. You could use that credit and determine, add it to what your sell price is, but you can only count it once. So you either count it towards your cost basis or where your sale price is. Okay, that's why I do it. That's how I do it anyway. Let me get this other. Okay, let me see. Looking at stock like BA, you can sell out 1 standard deviation at 11 cents. You can sell in October with 26 days. You know what? I thought I have a slide here. I think I do about the prices. I thought I did. Maybe I thought I put something in here about pricing. I don't like to sell any option below 25 cents. Okay, especially on the puts when you initiate. Whoops. I don't like to sell anything below a quarter. It's just not worth it to me. And when you sell the at-the-money calls, generally you won't ever have that issue come up where you're selling below 25 cents. So my suggestion is try to keep the stuff above a quarter, 30, 40, 50, whatever cents. It just, whatever it is. But, starting dealing with 11 cents, it gets to be a little dicey, especially when you start throwing in commissions and stuff. And Bank of America, my guess is it's a pretty low volatile stock, probably pays a dividend maybe. You're going out 1 standard deviation in 1 month. You're starting to deal with puts that are pretty low priced. That's a low probability event as far as the option market is concerned. So you're going to have a tough time getting yield when you do that. So you may want to maybe push that up to the 118 or something. But the other option is to go out to October too, for sure. Jim Graham. Okay, that's Jim. And let me see. Would it be advantageous to use European style options for the strategy? the question is, would it be advantageous to use European-style options for this strategy? Generally, with stock options, they're American. In fact, I think they almost all are. But to answer your question directly, European options typically have lower option pricing. And what I mean by that is extrinsic value. Because with European options, for those of you that don't know what that is, that's options that can only be exercised at expiration. They generally have lower extrinsic values because there's a whole risk factor now, meaning early expiration, that's removed. And you remove that risk, you remove some of the pricing. So Europeans tend to have lower pricing than American options, so that can tend to hurt this as far as our sale prices are concerned. Let me see, there can also, okay. Jim making a comment here, also be tax advantage with short put. Yeah, okay. My point of view, this time period is 3 times. Okay. All right. Okay, what I'm going to do, I'm going to jump over and I'm going to share my desktop here with the software. And I'm just going to spend a couple of minutes here. This won't be very long. I'll pull up a stock. Maybe we'll do Apple just for the heck of it. It's up a little bit today. And we'll just show you how we would search out a put, and then sort of how we would search out a call, and how easy it is. You don't have to worry about any of these Greeks and stuff like that. So let me share my desktop here, and hopefully you'll see my software, I think. Let me see, coming over. Okay. Okay, there we go. And I just see black right now. This just seems to be moving rather slowly here. Huh. Okay, folks, bear with me here. We're in the time tunnel here or something. Oh, it's coming. I see it. All right. I hope you all can see this. It sure looks weird to me right now, but I think it's there. Boy, did that take a long time. Anyway, I'm going to work on the assumption that everyone can see this screen right now. You should be able to see my quote screen here. You'll see the OEX and all this kind of stuff. Here's Apple down here, and I'm going to click on Apple, and I'm going to bring up this matrix. And honestly, I don't even know. I know they've paid, I think they're paying a dividend now, or I think they're planning on it, but it doesn't really matter. We'll just pretend that we're looking to do this in Apple. And for those of you that aren't familiar here, real quick, these are the call strikes up here. These are the put strikes down here. Apple right here is trading 489.44. So here's what we would do to initiate the trade. We'd say, oh, gee, you know what? I love Apple, but I don't love it at 489. I like it more at, like, you know, 450 or something, which isn't much for a $489 stock, but because you sell these puts for basically $2. Okay, but that's the concept. We may sell these are really out of the money, way out of the money. Again, the idea is find a put that you're comfortable with paying that particular price. Maybe it isn't 450. Maybe it's, you know, maybe it's a little bit more here. You know, maybe it's 465. You know, so we sell, you know, we collect a little bit more money here. You know, we collect for almost $5, a little bit better. But if we simply say, okay, I'd be happy owning an Apple at 465. Okay, take away whatever credit I get, which is 490, we'll call it $5. So call it, you know, about 460 bucks a share. Okay, so that would be our trade. We would simply calculate that. We could say, okay, how much margin am I putting up here? What's my yield going to be for 26 days? If in fact I don't get assigned to my put, so I can run all that math. And once I'm comfortable with it, I would turn around and sell the put. Okay, and that's it. I forget about it. Again, you can go ahead and make these adjustments if you want. If this thing gets down to 10 cents, you can always do that, but you don't have to. Most folks that I knew, guys that I work with, they usually just do this and see you later. You know, I'll see you in 26 days in the case of October here. So you would do that. Again, if it goes out worthless, we do it again. If it doesn't, we get assigned, then we deal with that. Now let's pretend that we got assigned. Okay, let's pretend for whatever whatever happened, we got assigned. Now we own 100 shares of Apple. Okay, that's up here. So now if we own 100 shares of Apple and it's the next cycle and we're looking for the call to sell, all right? Now what I want to do, I'm not looking to be an investor in Apple and this strategy. I'm looking to get out of this trade. This is a trade. I'm going to look for the option, the call option with the greatest extrinsic value, which happens to be the at the money, which happens to be at 490. So right here we're at 490 call, which is almost exactly at the strike. So I'm going to sell one 490 call right here. So going back to the recalculation of cost basis, if I'm in the stock for 460 bucks, and again, I know these numbers aren't going to be right because we're 490 and I'm collecting 14 bucks, but whatever. We'll just show the process here. If I'm in this stock for, you know, whatever the price is, I'm going to collect $14 and change here. All right, that's going to be mine. I can use that to recalculate my new cost basis because I know I'm going to keep this money. And my new cost basis will be whatever my old cost basis is, take away 14 bucks. Okay. And then I forget it again. At the end of the month, if Apple closes above the strike, I sell it, I'm done. I calculate my rate of return, it's all over. I've finished and I can start over. If the stock closes below 490, I simply go to the next month, it would be November now, and I do the same thing. If Apple's trading at 475 or whatever, I'd sell the 475 call. Again, it lowers it again. It keeps lowering my, I might be chasing that stock down every month, hopefully not, but theoretically could happen. But each month I do, I'm collecting, a fair amount of money. You can see this is a pretty good chunk of change here for Apple. I mean, granted, it's $490 stock, but still. But that's the idea. That's the idea. And eventually this call's going to get, or these stocks going to get called away. We're going to have it back in cash, and we calculate our return. Okay? And that's it. And we just simply do that each month. And, we try to mix and match it a little bit. I'm going to go back to the desk. I'm going to turn this off and go back to the PowerPoint. With the folks that I work with, we do it over a handful of stocks. We don't just, try to get it in one stock. We do a mix it up, so we don't have event risk in one stock necessarily. We might do 5 or 6 stocks at once. And you're always kind of working it. Some are in, some are out. You're cashing some puts are expired, worthless, some get assigned. So you're always kind of mixing and matching. But it's over time, this thing does, it's pretty well. And again, the idea is not to build a portfolio. We're not trying to build a portfolio here. We're trying to trade, okay, with minimum amount of effort, honestly. All right, I think that is what we have. Let me just go to the last slide. All right, in conclusion here, the strategy can be completely hands-off, or it can, we can adjust intra-month if necessary. Again, I think that 10 cents is a good number. That's what I use. That's what a lot of the other guys use. You could probably be a little more or less aggressive if you want. Employ risk management, especially if trading high-priced options. I alluded to the idea that obviously we have risks, our stock price risk here. So if you're inclined to use OpScan to search out high-priced options, that's fine. It's a great strategy. No going in. When you have high-priced option stocks, they're high-priced options for a reason. And that reason is that the market perceives high risk in those stocks, meaning high price volatility. So if you're going to do that and you're not maybe comfortable with owning a stock that's being, that they're showing, make sure you have some kind of risk management in place if you have to. Nothing says that you can't have some kind of stop out loss here in the stock. So keep that in mind. And again, the yield and the net costs are affected by option prices, okay, that extrinsic value portion, all right? Quiet stocks, dividend stocks, well-behaved stocks tend to have lower priced options. So those are my concluding remarks. Again, just to reiterate, I think I can't find it on that one slide, but I remember specifically putting it in there. I don't know how it got removed, but I would not sell any put below a quarter, below 25 cents. It's just with commissions and everything, and it's going to be kind of tough to generate much yield. All right, that's all I have. I'll be happy to take some questions here if anybody has any. What would be the max drawdown in this strategy? Well, max drawdown's always tough because you don't know what it is until it's over. I mean, the markets act the way the markets do, and you try to minimize that as much as possible. And historically, this type of strategy, especially when blended over more than one stock, maybe over a bunch of stocks, does very well. It's got a high, like I said, a high success rate. When I deal with stocks, when I'm looking at stop out, if I were to pull a stock out and have a stop loss on stocks, ours is 25%. If we see a stock that's down 25% in our portfolio, we get out of it. As far as the drawdown for this entire strategy over time, I mean, we haven't had a huge thing, but historically it's been very well. I don't know what the max drawdown. We haven't actually back tested this or run this, in a portfolio where we could actually measure that. Other than we've got some guys doing it, and I do it off and on, and we have some clients that do something like it, but we don't have any real data on that. So, but it's again designed to be sort of a high probability type of trade. It's not, especially when you're selling these puts out of the money, and you keep selling at the money stuff, calls. You're sort of filling that bucket up every month, with cash. And even if the bottom of the bucket's slipping down a little bit in terms of the stock price falling, you're trying to fill it up. And that might be a good argument not to do it all in one stock. You might want to spread it out over 3, 4, 5 stocks or even more maybe if you got the capital. So. All right, well, here's my contact. If anybody has any questions or comments or ideas for any future webinars, please email me, call me, send courier pigeon. I'm happy to answer any questions or any future topics, consider anything. So anyway, if there are no other questions, I think I will sign off and wish everyone well for the rest of the trading day. My broker charges low fees if I buy stock and sell options, but only options high margin. My broker charge, I'm just reading a question here. My broker charges low fees if I buy stock and sell options, but if only option. Okay. You may want to, there's a question here about margin on naked option versus a buy right, which is a covered call. Two things. You could do the covered call instead of the put sale. It is essentially the same trade. So if you're having a problem with your broker with margin issues by selling a put, you could always do the covered call. It's the same. It's not. There's really no difference there in terms of performance. But the other suggestion maybe is to maybe clue your broker in and have them go to our website or get some information on naked puts versus covered calls, because there is no difference. in terms of risk. And it's generally a little bit easier just in terms of execution, just to sell the put rather than have to do a covered call. But that's a good point, Peter, and it's well taken. There are some guys out there that just hate naked puts, but they're happy with covered calls, so go figure. Anyway. All right, well, listen, folks, it's been my pleasure to be here today, and our website. Our website is, we've got two websites. We've got DiscoverOptions.com, and I should have put mine up there. It's PLECapitalManagement.com is my website for my registered investment advisor. So both those websites have information on all this stuff, and you can reach me at either website too for any other questions or any other comments. Well, listen, folks, it's been a pleasure today. Enjoy the rest of the trading day. Enjoy the rest of your week. Although it's a full week here, I'm watching the market. SPOOs are down a little bit. Anyway, all right, that's all I have. Again, my pleasure, and I am signing off. Thanks for coming.